everybody. I'm Rhoda Shermer, and welcome to NFRPP's March program. We're all gathered here on Zoom and live streams to learn as much as we can about the complex issues of our fiscal policies, debt, entitlements. Very timely program. I want to thank our distinguished speakers, Simon Johnson, Ronald A, and our moderator, Peter Coy, for joining us to help us get a better grasp of the challenges and potential solutions. Thanks so much for being here. And now I'd like to introduce you to Peter Coy. Many of you are familiar with him because he's been a friend of ours at other programs. And he's a great moderator. And I'm wondering, for those of you who are not familiar with his New York Times columns, you should consult them. I urge you to do that. He's an opinion writer for the New York Times, and his great columns cover economics, business, and finance. They're wonderful reads. So, Peter, I'm going to turn the program over to you, but I just want to remind our viewers that the Q&A at the bottom of their screen is a button they should push often, ask questions, and that you will be watching for them. So with that, Peter, the program is yours.
Rhoda, thank you very much for having me on again as moderator. Always enjoy these. Tonight's program is called Understanding Fiscal Policies, Debt, and Entitlements. And we have two really wonderful speakers. Simon Johnson is the Ronald A. Kurtz Professor of Entrepreneurship at MIT Sloan School of Management. He heads the Global Economics and Management Group. He's on leave from the position of Senior Fellow at the Peterson Institute for International Economics. 2007 and 2008, he was Chief Economist at the International Monetary Fund. He holds a BA from the University of Oxford, an MA from the University of Manchester, and a PhD in economics from MIT. His latest book is called Jumpstarting America, How Breakthrough Science Can Revive Economic Growth and the American Dream, written with Jon Gruber, explains how to create millions of good new jobs and make money work for us through public investment in research and development. This proposal has attracted bipartisan support. That's all in your program, but Simon has a new book coming out, which he's just about to hold up in front of the camera, called Power and Progress, coming out in May. So maybe we'll get a little preview of that too. Ronald A, I've known for a long time, senior scholar and professor of economics at the Levy Economics Institute of Bard College. He's currently the 2022-2023 Distinguished Visiting Scholar at Willamette University. Previously was a professor at the University of Missouri, University of Denver, been a visiting professor in Rome, Bergamo, Paris, Brno, Nankai, Campinas, Bogota, Mexico City. Fulbright Scholar in Bologna, Italy, University of Tallinn, Estonia, was a BA from the University of the Pacific, MA and PhD from Washington University of St. Louis, where he was a student of the great Hyman Minsky. He's one of the developers of modern monetary theory, an approach that focuses on how money really works in a sovereign nation like the USA. He will discuss his recent book, Making Money Work for Us. Thank you all for being here today. And by you all, I mean the speakers and the audience, because this is going to be a conversation. It's not going to be canned presentations. We want to hear from you early and often. And I will make sure that we are responsive to what you want to know about from these speakers. And I'm going to start out with something that's on everybody's mind these days, which is, do we have a banking crisis on our hands? We saw the failure of Silver Lake and then Silicon Valley Bank. Both the Silicon Valley Bank had to be taken over by the FDIC, and then Signature Bank was seized over the weekend. Other banks have come under strong financial pressure. The Credit Suisse of Switzerland required a big injection of funds from the Swiss government, and the Federal Reserve had to come in with, let's just review what they did. They basically extended insurance to all of the deposits of the two banks that were seized, not just the first $250,000 per account. And they provided a new way for other banks to borrow from the Fed by posting collateral valued at face value, which is a huge, huge benefit to these banks because the actual securities, because of rising interest rates, are trading for much less than that. So this was quite a big deal. And yet it doesn't seem as though the markets have entirely settled down. So there's still signs of disruption, and there's still this feeling that maybe things could get worse. So I want to ask the two speakers. I'll start with Simon, then go to Randy on this one. Do we have a banking crisis on our hands? If so, why? If not, why not?
Thanks, Peter. I think that is the right question to start with. We definitely have a crisis of some proportions on our hand. I do think the authorities acted decisively. They acted controversially, and we can get into that if people are interested. But I think the measures that they took in the United States have stabilized the situation for now. And I think that that's also, by the way, about the power of the American budget and the American national balance sheet. Again, we can expand on that, the role that it plays. I don't think there's negative consequences for taxpayers, but that's a very pertinent question. However, we live in a globalized world. There's also issues in Europe. You mentioned Credit Suisse. I think the Swiss, again, have done what was necessary in the moment. Again, not something that they particularly wanted to do. So we'll see how they get on with it. But there are real concerns, I think, Peter, today and heading into the weekend around the euro area and what happens there. They have a bit of a track record of not handling this kind of disturbance in the ideal manner, and we have to worry about the consequences. And I think we need to fortify, from a US perspective, again, fortify our position in the financial sector, fortify depositors, make sure nobody is at risk, and do that in a responsible and proper manner as soon as we can.
Randy, when you answer, I want to ask you the same question, but I know one of the tenets of modern monetary theory is that a sovereign nation with its own currency doesn't need to worry about a run or a disaster like this. But Switzerland does have its own currency, but the members of the Eurozone do not. So can you talk about whether that is fertile ground for a financial crisis, banking crisis?
I definitely 10 years ago, it would have been a very, very severe problem. I think that since Draghi said whatever it takes, and with various adaptations that they've made over the past decade, I think that they can handle the crisis in a manner pretty similar to what we're doing right now. As Simon was saying, we can certainly afford extending the deposit insurance to all of the previously uninsured depositors. We can afford to lend at face value against assets that have cratered because of the very sharp switch of interest rate policy from near zero for a very long period of time, and then a rapid increase by 4 percentage points in 1 year, which has wiped out about 70% of the value of some of the long-term securities that the banks are holding. And so it's pretty easy to see us taking care of this problem. And I think that now the Euro area also will be able to handle it. Whether or not they'll move fast enough is a different question. So I'm just talking about the capability. Will they actually do it? Maybe not.
Yeah. So at this point, I'm going to step back and ask even a more general question. A lot of people have been talking about a recession in 2023 or 2024. What do you each think about that possibility? I'll start again with Simon. And if so, what would trigger it, or why would it not happen?
Well, I think, unfortunately, the events of the last week make it somewhat more likely, Peter. It's a little early to make a full assessment. The Federal Reserve is obviously in a phase, and Randy alluded to this, of trying to slow down the economy. They feel that inflation is too high, and they feel that higher interest rates will do that. Now, it is possible when you raise rates and disinflate, lower the inflation rate, that you can do it without a recession. And I don't think the Fed wants particularly to create a lot of unemployment. But it's also the case that often when you raise interest rates, you do cause a slowdown in investment, you cause a slowdown in house purchases, you cause a slowdown in various other parts of the economy. If you layer on top of that a financial disturbance. And if that financial disturbance doesn't mean people lose their deposits, which I don't think is going to happen, but just that people become cautious and credit becomes harder to get, then that will make some form of recession more likely. So yes, I think we're edging towards that. Now, if we add a global disturbance or a euro area concern, and I think Randall and I sharing the same concern in slightly different words, then that also increases the probability of recession.
So talk about, you mentioned both credit becoming tighter and people wanting less credit. So both the supply and demand are shifting at the same time. So the interest rate might not change, but the amount of activity could change.
Yeah, people talk about financial credit conditions, and what they mean by that is exactly what you said, Peter. That how easy is it to get a loan if I want a loan, but also, do I want a loan? Do I feel that maybe I should just wait on this investment project? I don't need to do this renovation of my house. I'm just going to wait 6 months, see what happens. Do I still have a job in 6 months, and so on? A little bit of hesitation like that, because of the way we run this economy, can snowball a little bit and add up to a significant macroeconomic effect, meaning slower growth. If we have growth that's negative for 2 quarters, we call that a recession. It's a bit of an arbitrary measure, to be honest, but it can also mean fewer jobs, and it can also mean higher unemployment, and people get discouraged, so they leave the labor force, and so on and so forth.
Your thoughts, Randy?
Okay. Well, if I look back at the data and I plot the Fed funds rate and shade the periods in which
talk about what the federal funds rate is, first of all.
Well, the Fed funds rate is the central bank's target interest rate. It's the overnight lending rate at which banks lend reserves to each other, but it is traditionally the target rate of the Fed. So it's the monetary policy rate. That is what they have increased by 400 basis points. Okay. Anyway, if you plot the Fed funds rate over time, go back to 1958, what you will see is the Fed has raised the interest rate going into every single recession that we have had. And many of these recessions have had a major bank failure, which at the time was the biggest bank failure that we had ever had. Now, this time we just had the second largest and third largest bank failures we have ever had. Add those two together, maybe you get to number 1. Okay, so this looks like every other recession that we've had. And so far, it looks like the way that financial crises happen. Now, does that guarantee? No. I think that it does raise a very strong probability of recession. Maybe we will get through this one without a severe financial crisis. But I think the pieces are there. We have wiped out net worth of the banking system taken as a whole. Now, every bank failure is idiosyncratic. And we look at the 2 that have just failed. They have their own idiosyncratic problems, okay? Don't hedge any interest rate risk, okay? You have a tremendous amount of uninsured deposits in the case of Silicon Valley. And that opens you to runs. It makes runs much, much more likely. And that really was the bank's problem. Although when we get into the details, we're going to find lots of other problems. There always are when you do the post-mortem on a bank failure. But what I'm saying is we have a systemic problem that was set up by the Fed.
Yeah, so I'll go stick with you, Randy, and then we'll go to Simon. There are various ideas for how to make banks safer. Rohan Gray, for example, has an idea, Larry Kotlikoff, and on, but many of them are around the idea of reducing the leverage in the banking system. And the central bank digital currency is another idea, but I don't want to go too deep in the weeds here, but Randy, start with you and then go to Simon. Do you have any thoughts about whether we need to fundamentally restructure how banking works?
Boy, that would be nice. Yes, ideas. How many of those are politically feasible is probably a very limited subset of what would be very nice to do. So as you said, Minsky was my professor, and Minsky spent his whole career writing about what we can do to try to improve the safety, soundness, and reduce the probability of financial crises. So one thing is, what we need to do is focus on cash flow analysis. If we had done that in the case of Silicon Valley, we would have seen that there is potentially a huge problem with the cash flow. They had
spell that out a little bit. Just
Oh.
break it down for people.
Okay, on the asset side of the bank, typically a bank has loans. In the case of Silicon Valley Bank, they had mostly bonds and securitized mortgages. So government bonds, securitized mortgages. Now, these should be safe. And so it makes sense to hold those things. They're very safe assets, very close to zero default rate. On the liability side, they have deposits and they have to pay interest. So normally you have your earnings on your asset side, and then you have your costs, you're paying out interest on deposits on the liability side. And the difference between those two is your profits, and it covers your operating costs, and it allows you to build equity as the bank grows. Silicon Valley grew extremely fast because they had a tremendous supply of deposits flowing in, and they decided to put them in a very safe asset. Okay, fine. The problem with those safe assets is that the cash flow is very small. And cash flow analysis might have said that, maybe you shouldn't be growing so fast. And you should be accumulating more net worth. Okay, where is the net worth growth going to come from when your earnings are so low? Typically, that is not the way the banks are evaluated. There's much, much more that we could do, but I'll just stop with that one point.
Yeah, Simon.
Yeah, I would focus on the leverage, which is the liability side. And I think that the key there that everyone should understand is that people who run these banks are paid on the basis of what's called return on equity. So how much money they make compared to their shareholder equity on their balance sheet. Return on equity unadjusted for risk. So that what happens then, Peter, as you know, is they have an incentive to take a lot of risk, because when things are good, and there are lots of good times, then they get high returns. And when bad things happen, I think this is straight out of Minsky, but Randall can correct me, bad things come, they come as a surprise, they always come. And then the downside risk is not borne particularly or entirely by the executives. They can put it off onto who? Onto deposit insurance, onto the Federal Reserve, onto the taxpayer, maybe potentially. So this imbalance between the upside and the downside means you've got to supervise them very carefully, and you've got to limit the leverage. And the best way to do that is to require much higher equity capital, loss-absorbing equity capital relative to the size of their balance sheet. Now, bankers hate that. They don't invite me to any conferences. I don't even get invited to cocktail parties anymore, because I've been saying the same thing for 15 years. So have other people like Sheila Bair and Admati at Stanford. And, they're right. And they've been proved right, again, I'm afraid, with this episode. So we just have to do another round, I think, of raising capital requirements, lowering leverage, and improving supervision. And I'm all in favor of the closer analysis of cash flow in the way that Randall's recommending.
Simon, just help people understand, when you saw loss absorbing equity capital, what's the concept there? Just lay it out a little bit.
It's a little complicated, and that's not by accident, Peter, because bankers like complicated.
But basically, the general idea that has to be worth
absolutely. Yeah, the basic idea is, if you fund any business, you can either do it with debt or with equity. And most non-financial businesses actually have a lot of equity in the business, because if the economy gets bumpy, it's that equity that is there to make sure you remain solvent.
And the equity is the shares. People own a share of the bank versus debt, where they're lending money to the bank.
That's right. So to be solvent, what you need is the value of your assets exceeds the value of the liabilities that you owe in the form of debt. So if you finance something entirely with equity, it's very hard to go bankrupt. If you finance something entirely with debt, then if your value of your assets falls a little bit, that debt is worth more than your assets. That's insolvency. Once people figure that out, there's a run on the bank, and that has these consequences we're talking about. So equity, it sits on the liability side of the balance sheet. It's a buffer that can absorb those losses. So when you have losses, the equity goes down. When you have good years, of course, the equity can go up unless you pay that out to the shareholders, so you don't keep it on the balance sheet. But that's the key buffer. And the reason we talk about loss absorbing equity, Peter, as you know, is that many of the layers of complexity that have been put on this through lobbying, frankly, mean that there are some various measures of equity or measures of bank capital that are used that are kind of phony, to be honest, and don't absorb the losses. So you've got to be very careful at what you're looking at. This number did increase after the financial crisis and after Dodd-Frank and because of international agreements, but it got rolled back during the Trump administration and eroded, I'd say, by poor supervision, which is mostly the responsibility of the Federal Reserve at this point. So it's a bit of a cycle and a bit of a battle, and we have to go do it again and make the banks operate in a safer manner, because we just had a really big accident.
Okay, so I'm going to go. I have two questions, excellent questions from Jean Cornell. The first one is, I'm going to ask his second question first because it applies to Simon. When you talk about phony equity, what do you mean by phony equity? What's something that is you regard as maybe not as that safe after all?
Well, tax-deferred assets, Peter, if you want to get into it, they're not loss absorbing. They count towards regulatory capital. But one of the classic ones, I think, is actually something that is sort of a weird hybrid, neither fish nor fowl, which is convertible bonds. And so a lot of times the banks say, well, we have these bonds that will convert to equity if there's trouble. So don't worry, we don't need more equity.
In other words, that way the bank will not have to pay interest, which will save it money.
Yeah, right. So you got debt and equity, but some of the debt can convert to equity if you need more equity. That's the idea. The problem there is, Peter, there've been many experiences where the triggers to make that conversion are not activated, in part because the authorities are worried that if they convert this debt into equity, that'll have a repricing effect across the whole financial sector. And as everybody just has been reminded in the last week, it's all about contagion. It's all about, okay, is this just one bank that did some funky stuff and we can let them go? That was actually the crypto bank, Silver Lake, that you talked about. We just let that one go. But if it's something that has shared characteristics with other banks, Silicon Valley Bank had a lot of uninsured depositors. It had the valuation problem that Randall talked about for the government bonds that they were holding. So when people do that math, say, oh, they had a run. One third, Peter, as you know, of their U.S. deposit base tried to leave the door in one day last Thursday. Yeah. Yeah. So then people say, well, where else could this happen? Who else has numbers like that? And that's a contagion. And so when you really need this pure loss absorbing equity in those sudden disastrous moments, and we get a lot of those sudden disastrous moments in the world of finance, and anything that isn't that is not, I'm afraid, going to be sufficiently stabilizing. But
you know what's ironic about the failure of Silicon Valley Bank is that the thing that finally pushed them over was that they tried to sell shares. They were actually trying to fix their problem by selling the purest of the pure equity. We're going to just sell shares to investors. And when people saw that, instead of being encouraged, they were alarmed, and that got the run going. Well, I think they were particularly alarmed by the fact they couldn't sell the shares. Right? So there was the fact that people were hesitating when they did the numbers. That was a signal to the market. And it is, it's an unfortunate just fact of life that it's actually quite hard to do numbers on a lot of these banks, and we outsiders don't see daily flows in and out of the banks, but we do see the equity price. So a lot of times movements in the equity price are used can become a trigger for a run, even though equity is something totally different from your deposits. But those things are very connected in the psychology of the market. And I think in the reality of the market, in the sense you're looking for signals, and where else can you get a signal? Because you don't have daily or hourly or minute by minute data on how are they doing in terms of deposit flow. Okay, now here's a question for Randy, and it comes from Jean Cornell also. I think it's a great question. First of all, Randy, tell us a little bit who Hyman Minsky was and what you learned from him. And then the specific question is, are the bank runs a good example of Minsky's financial instability hypothesis? And explain what that hypothesis is.
Okay. Yeah, so I wanted to add something on the capital anyway, which was Minsky's idea that there is a caveat to increasing the capital ratios, which is that you're going to reduce the profitability on capital, the rate of profit on capital, and that can induce them to try to grow faster and take on more risk. And the second caveat is that how big does the capital ratio have to be to really make banks safe? And if we go back before limited liability, where the owners were liable for double their investment in the bank, what we saw was unbelievably high capital ratios, which we're never going to get to. But that sort of tells you what you needed in order to actually protect yourself, because since the owners were really at risk, they made sure they had capital ratios of 40% because their own money was at risk. So I'm not disputing anything that Simon said. Higher capital ratios do provide more protection. If you think about it, Martin Mayer used to put it this way: one bad loan eats up all of the profits of 20 good loans. And so because banks mostly operate with other people's money, not their own. This was another saying of Minsky. They're financing their position in their assets with other people's money. The ratios are very different from any other kind of corporation. They have very little of their own money at risk. Okay, who was Minsky? Well, in my opinion, he was the greatest economist of the 20th century, American economist, certainly of the second half of the 20th century. And he started in the 1950s arguing that, okay, we've gone through the Great Depression, World War II, we got the New Deal, we wiped out most of the private sector's debts because of the Great Depression. World War II allowed the private sector to accumulate a huge quantity of very safe assets in the form of US government bonds. The debt ratio reached 100% of GDP. The deficit had reached 25% of GDP. So we had safe assets all through the private financial system and even in household portfolios. And so the risks, the financial risks, were very low at this period. Everybody also was very conservative because they still had memories of the Great Depression. But in the late 50s, he started writing saying, this is all going to change because stability breeds instability. The fact that things are so stable now and strong means that people are going to take greater risks. As we go along, the risks are going to build, and we're going to have financial innovation to try to get around the New Deal constraints, so that gradually the New Deal constraints that had been put on the banking system would not be effective anymore. And so what he was writing about in the late 1950s is what started to occur by the early 1970s. So we start getting financial crises. We had a little minor one in 1966, which was in the muni bond market. Then we had Penn Central default on commercial paper, which was a new innovation. You don't need to go to a bank to borrow. You can issue your own commercial paper. In some respects, the non-financial firms were seen as being no more risky than banks. And so they could finance cheaper by issuing commercial paper. Then that blows up. Penn Central goes bankrupt. Then we have Franklin National Bank fails. Biggest bank failure up to that point was 1974. And then the Volcker years, we wipe out half of the thrifts and so on. And we get the development of a new form of capitalism that Minsky called money manager capitalism, which is, Simon was describing a lot of it. It is all of this leverage and changing the way that banks work, the rise of what we now call shadow banks in the hands of money managers that have much greater leverage ratios than even what the banks have. And really, it was the shadow banking sector that brought on the global financial crisis and could be the trigger for the next financial crisis. So that's a very, very brief summary of Minsky's work. And anyone who's interested can go to the Levy Institute. It has the Minsky archives. And we have his works digitized so that people can read his writing.
So to answer the question from Jean Cornell, do you think that the failures of these two banks over the weekend are examples of the financial instability hypothesis?
Yes, and I think they're examples of what happens when the central bank sort of breaks a covenant that it has had with the banking system. So the way I look at the problems with Silicon Valley is that we had been in a low interest rate environment for 20 years, and we had been in a low inflation environment for 20 years. And banks adapted to that, and they came to expect that that is the future, that we've banished inflation, and the Fed is not likely to raise interest rates significantly. And in this new environment, the balance sheet of SVP didn't seem crazy. In retrospect, it seems very crazy, of course. And everyone asks, why on earth didn't they hedge the interest rate risk? Well, that's costly. And if you don't believe it's going to happen, you can save your money by not hedging the risks.
But okay, I want to finish one last question for Randy, and then I'll go to Simon. Randy, if the hypothesis says that stability breeds instability, then what does that mean? Should we want instability to prevent more instability, or what do we want?
Right. It sounds so pessimistic, doesn't it?
Yeah.
But his point was that you can put in place the regulations like we did with the New Deal and Dodd-Frank, we put in some regulations. But you have to realize that the financial system has huge incentives to innovate around those. And they are going to do that. And they're also going to go to Congress and ask for relief. Okay, we need regulatory relief, right? Which is what they started doing immediately. They hire teams of lawyers and lobbyists, and they try to get some relief from those regulations. And to some extent, you can see their argument, because banks are heavily regulated, shadow banks are not, and they've got to compete with them. And so you can win arguments by pointing that out. And so gradually over time, they're going to get around them. So does that mean we give up? No, exactly the opposite. It means we have to be very diligent. We have to continually adapt the regulations to take account of the bank innovations so that we're prepared.
Sure. Okay, Simon, you wanted to say something.
Well, I agree with almost everything Randall said, and including that last statement. I think was absolutely spot on. You know, you're never done, I think is another way of putting it, Peter. and they always come back at you, and they always undermine the stuff that's safer and in the social interest. I have a slightly different take on the Fed and its covenant, because I think that by the middle of last year, it was pretty clear that we had an inflation issue, and it was also fairly well communicated by the leadership of the Federal Reserve on the monetary policy side that interest rate would be rising to some extent. Yeah. However, as far as we don't know the full blow by blow, we'll learn more, I think, and I hope that everything will be published exactly what happened around Silicon Valley Bank. But here's a couple of little nuggets, Peter, that people could muse on. One is that Mr. Becker, the CEO of the bank, had lobbied long and hard to roll back regulation and had been quite successful in lifting some of the rules that applied to exactly his size of bank. Number one. Number two, Mr. Becker was a member of the board of directors of the Federal Reserve Bank of San Francisco. Now, Fed has a weird governance structure. It doesn't mean he was actually in charge of the San Francisco Fed, but it does mean he was at the table. It does mean he was at all the cocktail parties. It does mean that socially that bank and its top leadership was very integrated with the San Francisco Fed. Who supervises Silicon Valley Bank? Well, there's a number that's supervised in part by the California Department of Finance, in part by the FDIC, and by the San Francisco Fed.
Yeah.
Now you start to see why we have a problem. Now, Randall mentioned other people's money, the Minsky version. I would remind everyone that the first version, I think the person who coined that term originally was Louis Brandeis, who wrote a really good book after the crisis of 1907. And it was part of the political debate that led to the founding of the Federal Reserve. And it was all about bankers being too powerful and then causing problems. And, you know, could we structure the Fed in a way to curtail that and so on? All right, well, we couldn't quite do that. We haven't done it again. But these are the questions that have to be asked. Why did the supervisory side of the Fed fail to get the memo from the monetary side of the Fed? Why did they allow Silicon Valley Bank to continue with the position they had, which was already probably a little bit underwater by the middle of last year, but it became much worse. And the evidence The reports are that they actually reduced their degree of hedging, which means they increased their exposure to interest rate risk as the third and fourth quarter went on. So supervisors are all over these banks all the time, and they let this one go through. I think this is going to be very informative and instructive, Peter, when we learn all of those details in the blow by blow. And I think there's a bunch of things within the Federal Reserve System, particularly on supervision, that are going to need to be fixed.
I'm going to ask one last question about banks and the current issues, and then we're going to move on to the debt ceiling. But this is the last question. It's from William Arnone from the National Academy of Social Insurance. And he asks, is Roger Lowenstein's New York Times guest essay today on the right track, i.e. the federal government will need to come to the rescue of others? Thoughts by either of you?
I haven't read the essay, but I'm a big Roger Lowenstein fan, so I'll get right on it, I promise, after this. Look, I think that what we did, just to recap, you gave a very good summary at the beginning, Peter, but just to recap everyone, is in addition to there being an extremely generous borrowing window from the Fed, where you can borrow more than assets are worth, more than their market value. It's the first time the Fed's ever done that one. In addition to that, there was sort of ex post deposit insurance provided to previously uninsured deposits at Silicon Valley Bank and Signature Bank. And that has created the implicit view or an implicit guarantee, if you like, or an implicit assumption that the government would do the same for another bank. And there are some other banks that I'm not going to name, but you read the newspapers, you see which ones they are, that their uninsured deposits would be protected. But first of all, that's an implicit guarantee. Secondly, they're not paying for it, right? So the uninsured depositors at Silicon Valley Bank got insured, but they never paid a premium. Now that's a heck of a good deal, right? In that Minsky moment, I'm not opposed. But right now, Peter, I think we should extend deposit insurance across all deposits. I think uninsured deposits are a bad idea whose time is gone. And you pay the premium, and the premium has to be paid, not shifted onto little depositors like that. Premium has to be levied directly on these people who were previously uninsured. And if that leads to them leaving the bank and going to money market funds and buying short-term government debt, that is fine. Short-term government debt is as safe as it comes, which is, I know we're getting onto that now. My point is, I think the answer to your question is yes, the government's going to need to do more. I would rather do it preemptively, in an organized manner, and make people pay for the insurance they get. That's fair. That's the American way. And then we'll talk about the fiscal implications.
Randy, if you have something to say,
Yeah.
fine. If not, we can move on.
I'll add that, again, each failure is idiosyncratic, and we will find they made big mistakes. The Fed was signaling it was going to raise interest rates. The question was, how high would they go? We could look at the expectations of interest rates, and we see that they did not go up to 4%. Powell kept warning markets, saying they're going to go much higher than you think they are. And he kept saying, and they're going to stay higher longer than you think they are. But for whatever reason, the markets did not seem to really believe it. I don't know why. They were discounting what he was claiming. On the premiums, if you think about it, we do this in a very bizarre way. After a crisis, we raise the premiums, and the banks are struggling along trying to recover, and we raise the premiums. And then when things start booming, they pressure Congress and say we should lower the premiums because the default rates have all gone down. So we lower the premiums, and we go through this cycle over and over again. We're raising them at the wrong time,
Yeah.
and lowering them at exactly the wrong time. So yeah, we should have, in a way, I'm sympathetic to the argument that we should be raising them. We should have much higher premiums if we're going to pretend that the FDIC insurance reserves are really going to be sufficient to deal with a severe financial crisis. I think it's about 125 billion. This is not enough to deal with a severe financial crisis. They're never going to be big enough.
Well, okay, so I think that's a great transition, not trying to usurp Peter's role here, because what I see, that this is the deposit insurance fund, which is just over $100 billion. And right now it backs, let's get the numbers out there, 10 trillion of insured deposits. And then these uninsured deposits that we're talking about are an extra 8 trillion. Mm-hmm. So how could 100 billion stand credibly behind 10 trillion? That is a very good question. And the answer is, of course, that behind the deposit, and the deposit insurance fund, like Randall said, is levied entirely on banks. And the problem with levying on banks is exactly as he just said, that when you have a crisis, their profits are low and it's hard to tax them. So the reason the deposit insurance fund is entirely credible, and the reason this is the right way to do things, and the reason the IMF, where I used to work, tells people around the world, whenever possible, build this kind of arrangement with safeguards, is because the US Treasury stands behind the deposit insurance fund and will fund it, lend money to it, if it needs the resources. And the Treasury and the Fed would, if we were talking about large enough magnitudes, the Fed would be involved as well. So really, Peter, it's the balance sheet and the fiscal credibility of the US government and the taxpayer, which means everybody, I think, watching today, that stands behind the deposit insurance fund and makes it possible to stop runs, which is a huge, incredible power that we very rarely think about and very rarely appreciate, that we the people and the taxpayers of the United States have that power. And it has been used very wisely recently, and I hope it will continue to be used wisely.
Great. All right. Well,
Can I just object to one thing, which is that in the past, the FDIC has done strange things, trying to avoid having to use its insurance funds because it knew it could not get more from Congress. So the problem is that, yes, the Treasury is there, but we have to have congressional approval, and Congress isn't feeling really good about bailouts right now, and usually is not. So in theory, yes, the Treasury could always provide more funding, but we've got to have Congress behind that. So there's a bit of a problem.
so actually that's a great segue, because we're about to pivot from the Fed to Congress and talk about the debt ceiling. And folks, please put in your questions in the Q&A, because we're going to have a rollicking discussion about the federal debt ceiling. And we may talk about $1 trillion platinum coins, or we may not. But I guess I'll start out by just asking a very general question. First of all, the debt ceiling, as probably most of you know, is the self-imposed limit of Congress on the amount that the federal government can borrow. We have hit it. And at this point, the Treasury is taking extraordinary measures to stay beneath that ceiling. But those extraordinary measures are going to run out sometime, probably around June or July. I don't know the exact date, that keeps changing. But at that point, either the government would just stop making a lot of payments, or it would default on its debts, or some other equally awful thing. And in general, they always step back from the brink. But after having seen what happened with the Republicans in Congress raking Kevin McCarthy over the coals before finally electing him Speaker of the House, you really start to wonder if the people who are sitting there are willing to push the United States right over the edge into default to achieve whatever goals they have. How worried are the two of you about the impending debt ceiling problem? Simon, start with you.
I'm worried, not very worried yet, but I'm definitely worried. I think the debt ceiling is a really bad idea, Peter. I mean, it comes from the history of the American Republic. Approve all debt issues. I understand that, and that became a debt ceiling in the last century. But
Simon, can you stop you for a second? You froze for a second, so just repeat what you said so we don't miss anything.
The American Republic was born in a state of fiscal disarray. And in the Constitution, it says that Congress needs to approve every debt issue. That became or morphed into this debt ceiling business. But really, it's extremely weird. And I don't know any other country in the world that does it, Peter, because Congress already controls spending and taxation, right? That's very clear, unambiguous. They make the decisions. If you have a program that gets approved but not appropriations, it doesn't happen, right? So Congress controls the purse strings. I think that's how it should be, actually, in this kind of democracy. But in addition to those decisions, they then get a second bite of the apple, and it's often a different Congress that comes back around and says, well, you know what, you made those decisions already, but we're going to second guess it and then have some other debate around it. And we've had some dysfunctional moments in the past around it, because it becomes not a responsible, integrated, let's do a budget, even though we're not very good at calling things a budget, but let's do basically a de facto budget. It becomes, let's have this messaging fight about what's debt, what's a debt ceiling, what's honesty, what's purity, and so on, which is not where you want to have sensible fiscal discussions. And I think you're totally right, Peter, that as far as we can see, the particular dynamic in the House Republicans right now is extremely conducive to, I mean, what is the IMF likes to call rather, sort of a neutral term for really bad things, a policy mistake, right? We could easily have a policy mistake here, and that could be, I mean, I don't think we're looking at potential catastrophe, but that could be costly. And it has been costly in the past, other versions of this, could be costly again, could be disruptive. Now's not a good time. And actually now's never a good time for this debt ceiling thing. We should scrap the debt ceiling and have Congress do its job, which is control appropriations and decide on the level of taxation.
And Randy, what do you think?
Yeah, I think all sane people agree with this. The debt limit just doesn't make any sense. I have heard that Denmark has one too, but they automatically increase it when they reach it. Here it becomes a political fight, and so it gives a second chance. Democrats have used it too, but mostly Republicans, a second chance to rethink the appropriations. And it's dangerous. I heard Yellen talking about it because people said, well, they could prioritize the spending and they cannot do that. They can't say that paying interest on the debt is more important than paying the retirees. They can't do that. So there's actually no way around it that avoids catastrophe.
So Randy, this is a natural segue into your research interest, which is modern monetary theory. What the reason that the Republicans are threatening are making demands over the debt ceiling is that they're trying to reduce the federal budget deficit. And some of them have said things like, get it to zero within 10 years. What is your thinking about the federal size of the federal budget deficit?
Well, first, it is not determined by Congress. It is really not discretionary. If you look at spending flows and tax revenue flows, what you see is what contributes to most of the deficit is a collapse of tax revenues. That is when the deficit really goes up. Now, there is one big exception, pandemic relief. That's the only time you see that it was spending that drove the deficit. Otherwise, it is the fluctuation of tax revenue. When the economy slows down, tax revenue falls off a cliff very, very quickly. It's just amazing how much tax revenue falls. That's what produces the deficit, okay? And that's with existing tax law. So it is not because Congress decided, hey, let's cut taxes and increase spending and produce a bigger deficit. That's not how we get bigger deficits.
But there is a structural budget deficit in addition to the cyclical one, right?
Well, but again, that is going to depend on tax revenue, which depends on the behavior of the private sector. Look, so you're aware of the sectoral balance approach of Wynne-Godley, and
but yeah, give people a really basic version of that.
All right. So at the aggregate level, which just means the economy as a whole, spending equals income. This is an identity. It must be true. For every dollar spent, a dollar is received as income. We can divide the economy into different sectors, and it's convenient to divide it into the private sector, which is households and firms, the government sector, all levels of government, but the federal government's budget dominates that, and then the rest of the world, which is our balance against the rest of the world. Each one of these sectors individually can spend more than its income, can spend less than its income, or can spend exactly its income, okay? But at the aggregate level, if there is a sector spending less than its income, you know there has to be at least one spending more than its income. And if we look at the United States, we purchase more from abroad than foreigners purchase from America. We have a current account deficit, which means the rest of the world has a surplus against us. Okay, and I think everyone knows that. We run a deficit against the rest of the world, they run a surplus against us. If we look at our domestic private sector, it almost always runs a surplus. And this makes sense because households especially are spending less than their income at the aggregate level because they're saving for the future. So households are saving for college and saving for retirement. Firms balance at the aggregate level is sometimes positive, sometimes negative. So that one fluctuates, but households are always in surplus, almost always, one exception. And so finally, the balancing item is the government's budget. The federal government almost always is in deficit. And this is not something new. From the founding of the United States, the debt ratio has grown at almost 2% per year since the founding of the nation. And the debt ratio grows because we are running budget deficits. That is adding to debt. And the debt is growing faster than GDP. So anyway, this is a normal situation for the United States. You can find countries in which the government runs a surplus and the private sector runs a surplus, but that's only because they are big net exporters. So you can think Asian countries.
Right.
Those are the main countries that do that. Okay. Once in a while, you will have a country in which the private sector runs a deficit. That always leads to disaster because it means that they're spending more than their income. They are accumulating debt. It gets harder and harder to service the debt. And either some people start going bankrupt, some firms start going bankrupt, or they just choose to reduce spending. So in the United States, we did do that during the Clinton years. Our private sector, taken as a whole, ran a deficit. We collapsed into the dot-com crash, and then we really collapsed into the global financial crisis. So right before those two episodes, our private sector ran surpluses for the first time since 1929. And many people will recognize that date because we crashed that time too, after a private sector deficit. So private sector deficits create financial instability, the Minsky kind of financial instability. Those are not sustainable. Government deficits are normal and sustainable for a country like the United States that cannot be a major net exporter. The rest of the world is not big enough for us to be a net exporter.
So Lanny, one question for you, just to elaborate. The debt, when you run a deficit, you accumulate debt, and then there's a ratio of the debt to the GDP. Are you comfortable with the debt, the GDP ratio growing?
It's been doing that since 1789, so I would say I am used to it. Do I think it will continue? Yes, I do. Will the US someday be able to turn that around? Only if we can run current account surpluses. I don't know. The rest of the world would have to grow an awful lot faster than the United States for us to do that in the near future. So I think it's normal. I think it will continue to grow. Now, it doesn't have to grow relative to GDP. It has been doing that, though, for 200 years and at a much faster pace since the Great Depression. Can it continue? Yes, it can.
Okay. Simon, what are your thoughts?
Well, I have a slightly different take on American history. And that comes from, well, the root of the heart of the disagreement or the different view would be that while Randall is right, that if you look at the start and the end, that we have a lot more debt than we did at the beginning, but the philosophy of debt management before the World War II period was that debt was something that you increased in times when you had to spend, particularly wars, and then you reduced it in peacetime. So the debt actually was up and down quite a lot. Now, there was, of course, the need to finance a lot of spending during World War II, and there was a big surge in spending and in debt. And then the debt started to come down as well. But in that post-war system that was built with the US at the center and the US dollar at the center, what we found, and this was not deep scientific research, it was just a heuristic of muddling through, was there was a strong demand for debt, US debt among US residents who see it as a very safe asset. We've just been half an hour or 45 minutes talking about that, but also foreigners. So particularly after the 1970s, when the fixed exchange rate system broke down and the dollar started to float, a lot of people around the world wanted to hold foreign exchange reserves as a form of buffer. What does it mean to hold foreign exchange reserve if you're outside the US? Well, a big part of that is going to be in US dollars. So there's a very strong demand for US dollar assets, much of which is government bonds. And that is supported by the structure of the world. And that has an impact on our exchange rate. That does impact our current account, as Randall said. It also means that we can safely run a budget deficit. But I do think, Peter, to your point about debt to GDP, that is the key number to think about. And the honest answer is we don't know how much debt to GDP could be a problem. Japan has a higher debt to GDP than we have, for example. I'm not recommending that we go there, but that's one mark that we might consider. I rather like the idea that we grow the economy enough and collect enough taxes from people that we bring the deficit down and we stabilize the path of debt. And actually, that's what President Biden proposed in his recent budget. And in that budget discussion, which I hope we get into some of the details now, the key issues are, Randall alluded to this already, Social Security is one very big item, but also Medicare. We spend an enormous amount, healthcare spending, including Medicare. And the government, so healthcare spending is the topic, but the government spends a lot on Medicare. And one of the proposals that President Biden put forward that is really very important is to stabilize the funding of Medicare, because the current model runs into trouble around 2028. And we can easily extend that for 20 years, but not if we do nothing. If we do nothing, there is going to be real problems and dislocation. So I think that's a very real priority, and I think the president's put a pretty viable or very viable plan on the table. Let's discuss it and let's see what other alternatives there are.
All right, folks, we're coming up on an hour so far, and it's been a fantastic conversation. I want to keep going for a while, but I want to get your questions in, so please put your questions into the Q&A. One thing I want to do before we run out of time is give you each a chance to talk about your new books. We really haven't done that very much. So I'm going to start with you, Randy. Tell us about Making Money Work for Us.
Okay, well, it's a simple introduction to what money is all about. So, what is money really? Where does it come from? And how can we use that to pursue public and private interests? So
give me just a taste. I know it's hard to encapsulate a whole book in just a couple of minutes, but what would be the biggest surprise to a typical person who's not versed in your thinking?
Okay, and related to what Simon was talking about, that we can afford to do anything we know how to do and have the resources to do it. Money is not the problem.
So when you say resources, what do you mean by resources?
I mean, let's take Medicare, for example, okay? So Biden is proposing many good things, actually. I like a lot of his proposals. And I'm not even against raising taxes in the way that he's raising them, but this is not necessary at all to save Medicare. We can always afford Medicare in money terms today and in the future. 28 years down the road, whenever Medicare is supposed to go broke, we will still be able to make all payments as they come due. We're the sovereign currency issuer, and the thing we cannot run out of is money. All that Congress has to do is allocate the spending, and we can afford it. The question is, we are an aging society. Are we going to have enough doctors, enough hospitals? And does it make sense to continue to run a very large part of our healthcare system through the for-profit insurance sector, which means we devote a lot of resources, more than any other country in the world by far, to healthcare, because we have a lot of people that stand between you and your doctor. Does that make sense? Would it make more sense to train doctors and nurses and scientists to come up with new and better drugs and so on, rather than devoting resources to the insurance sector, whose job is really to deny your benefits? So those are the questions I would ask, and then my book is writing about. Let's identify the resources that are needed to green the economy, to prepare for a much older demographic with low birth rates. We're going to need more senior centers and so on. Let's identify the resources we're going to need. Let's start creating more, because we don't have enough human and non-human resources to deal with all of these challenges, and then allocate the funding in the normal budget process. Money is not the problem, resources.
Yeah. And Simon, how about, I guess, let's talk about your forthcoming book, Power and Progress.
So Power and Progress, our 1,000-year struggle over technology and prosperity. That's the subtitle. And that tackles the techno-optimism that we all see around us all the time, that says, oh, great things are being invented. Everyone's you're gonna get a higher wage. Your health is going to improve. There's going to be more opportunity. And okay, it might take a little while, because sure, the billionaires will get theirs first, but everyone will benefit eventually. And the key word there is eventually, because if you go back in history over the last 1,000 years, actually we go back 10,000 years, see if we can. Some very interesting, I think, observations there, or consistency. But over the last 1,000 years, we've got pretty good data on repeated waves of innovation that didn't actually raise people's wages, that didn't help their health, maybe even worsen their health, and actually didn't create new opportunity for most people. And when we say eventually, look, the early industrial revolution started in the 1720s. By the 1850s, most people had not gained very much at all. So it's like 100 years of intense innovation. Those benefits weren't shared. We have had some moments of shared prosperity, particularly from the late 19th century through the mid 20th century. And I'm with Randall. I think you should think about the real side of the economy. Where did we get the manager engineers? How did we roll out electricity? Factories became much more productive. There was automation, but we also created a lot of new tasks. And those new tasks meant new jobs and higher productivity, marginal productivity at the margin. When you're hiring a new worker, you give them a higher salary because they can do more, earn more value. That's the real transformation. And when we talk about artificial intelligence now, Peter, which is obviously very much on people's minds, including this week, we had like 4 or 5 major competitive announcements from people who want to own the AI future. I think we need to ask the question, all right, this technology, who's designing it? Who's in charge? What's the vision you've got here? Is this just about making money, or are you actually trying to solve the problems of the world? And what would it take to pull that technology towards real solutions and real improvements, including, Randall just flagged healthcare spending, right? Which is right now we spend 18% of GDP roughly in the US on healthcare. The British, who have a pretty good healthcare system, and they have very similar healthcare outcomes to us, which is why these comparisons they spend 8% of GDP on their system. Okay, maybe they should spend a little bit more, but we're spending a ton more for the same outcomes. What's that about? Let's grapple with these real problems, and then I might have a slightly different back-end model of the financing than Randall. I might want to raise taxes on high-income individuals and corporations a bit more. I don't know. I'm in line with the president on that. But he's not proposing crazy high tax rates compared to what we've had historically, what other countries have had. They're going to line up the fiscal resources. But I agree with Randall totally. You should think about what's the problem to be solved here, How do we mobilize the technology? How do we deploy that technology? And frankly, Peter, social media, what we got from social media was a disaster, right? We have well-documented episodes of Facebook being used to fan ethnic hatred in some countries. There's a lot of plausible, maybe not completely confirmed, but plausible evidence that social media has contributed to a lot of teen anxiety and really terrible, tragic issues. Because if you just say, let it happen and we'll sort it out later, well, that didn't work out too well in the last iteration. Artificial intelligence is extremely powerful. I mean, people are arguing about, is it as big as electricity or is it as big as the wheel? I mean, that's kind of where the argument is. Might be some hyperbole there, but let's not take the mistake of underestimating the way it can transform society. Let's grapple with it. Let's have the conversation and let's pull ourselves and public opinion and the billionaires maybe towards better technological outcomes, real solutions for real problems.
Okay, so I'm going to wrap it in a couple of minutes, but I just feel like I should try to wedge in a couple more audience questions we didn't get to. And so I'm going to ask just one of you to respond to each one just to speed things up, and try to keep your answers like lightning round, okay? So here's a question I'll give to Randy. About the debt limit in the US, can the Treasury just overdraft to keep making payments? Would the Treasury's bank, by the way, which is the Federal Reserve, ever fail to back a check because it would cause an overdraft? Would that count as additional debt? Could this make the debt limit irrelevant? Your thoughts?
Right.
And just quickly.
Okay, so we have a self-imposed rule that the Fed is not supposed to allow overdrafts. I am sure that the Fed does, because of the timing issues of tax revenue coming in and spending going out. Would the Fed actually bounce a check? No, I don't believe the Fed would ever bounce a check. So on a day-to-day basis, yes, I'm sure they allow overdrafts, but by the next day, the Treasury needs to move some funds into its account at the Fed. But the Fed and Treasury know how to make that happen. They always can make it happen. The Treasury can have some new issues, sell them to the dealer banks. The Fed will provide the reserves the banks need to buy those bonds. So there is no problem at all in getting the funds into the account. The two constraints are the budget constraint, which makes sense. You don't want the Treasury to spend without a budget. So you want Congress to tell them how much to spend. But then we have the nonsensical debt limit. So that one is a problem.
Okay, very good. And I'll ask this. That was a question from Ator, and I'll ask Simon another question from the same person. Very interesting. Can we just throw away the concept of a trust fund for financing Medicare, Social Security, and just talk about the level of service that a society we want to guarantee to ourselves? What about a trust fund?
Look, I think the issue is, can you provide sustainable financing for these important social insurance programs? Whether or not you do it through a trust fund is largely an accounting exercise. The question is, in my opinion, do you have the revenue and do you have appropriate levels of spending with safeguards and controls, so you're not handing it all over to private insurance companies one way or another, as Randall said. That's the key issue. And look, we're a bit short on revenue, frankly, and we know where to get the revenue by taxing people with more than $400,000 in income, and some wealthy corporations and venture capitalists. Yes, thank you. We just saved your bank, so we're coming around with the donations or the taxation fairly soon. So none of this is government expropriation. It's reasonable contribution to the social fabric of the country, and you can't accounting fudge your way out of it. You need the revenue, I'd say, Peter.
Okay, and I'm going to ask kind of one last question. I'm not covering everybody's questions, and I apologize for missing some of them, but I just think I want to try to wrap pretty soon. The last question, Michael James asks, how are younger Americans affected compared to older generations if the debt ceiling is not raised? Now, if you want to answer that question a little differently by just saying overall, how are younger Americans being affected compared to older generations, say by decisions that Congress is making, I'll allow you to interpret the question that way. Maybe I'll give you both a chance to ask that one, and then maybe that'll be the end. So Simon, I'll start with you.
Look, if the debt ceiling is really not raised and we go to the precipice and then fall or jump off, it's a disaster for everyone. Everyone. And you know, younger people have longer remaining life expectancy, so I guess it's more of a problem for them in that sense. But for older Americans, it's absolutely just as much a disaster. It would be a self-imposed disaster. It's a completely unnecessary disaster. It is completely irrelevant to what Randall's flagged as the real issues, the real problems that need to be solved. I mean, obviously, it's not in the power of anyone to hear, but it is a terrible, terrible, awful distraction. I'm only smiling and laughing, Peter, because I don't want to burst into tears on this video conference and have that recorded for posterity.
That would be embarrassing.
Right.
Well,
Randy?
I think there is great danger because we've been in this fiscal austerity mode for a very long time. It has led to substandard growth. It has led to higher average unemployment rates than what my generation was able to experience. The current generation and the one right before it were the first American generations to have a lower living standard than their parents did. Job opportunities are not as good. The pay is not as good. Real wages have been stagnant essentially since 1974. Yeah, they face a much bleaker future than what people of my generation face. And this is a scandal. And it does not have to be this way.
Yeah. I'm going to ask Rhoda to come back in, but I'll just say on my behalf, I want to thank you both very much. And Rhoda, what do you have to say?
Oh my God, this was a really powerful discussion. So much to think about. You guys did a marvelous job. Thank you so much. Peter, thank you for the good moderating. I want to just say one thing to the audience before we close out, and that is you all will be getting a survey. And I hope you will take the couple of minutes to fill it out because we appreciate your feedback. It helps us do better jobs in the future. And for those of you who felt that the program was very useful and beneficial and helped you think through some of the problems and the solutions, please consider donating to NFRPP. Every donation really helps us to continue to bring important programs like this on these timely issues. So thank you so much. We would really appreciate your help. Thank you, guys. It was wonderful. And I hope to see you again. I think we'll be visiting these problems and challenges ongoing.
Yes.
So thank you so much.
Thanks.
Good night.
Bye-bye.
Thanks, everyone.
Thanks.